The next question is E10.3. Haider Corporation operates a retail computer store. To improve delivery services to customers, the company purchases 4 new trucks on April 1st, 2019. In terms of acquisition for each truck are described below. So there are 4 acquisition of the trucks. So we need to make the appropriate journal entries regarding these 4 transactions. So truck number 1 has a list price of 15,000 and is acquired for a cash payment of 13,900. So which one that we should record? Of course, is the one that we pay, yeah, not the list price, because this is not happening in our transaction. So for the first one, it is debit truck number 1, credit cash 13,900. And then truck number 2 has a list price of 20,000 and is acquired for a down payment of 2,000 cash and a zero interest bearing note with face amount of 18,000. The note is due April 1st, 2020. Haider would normally have to pay interest at a rate of 10% for such borrowing, and the dealership has an incremental borrowing rate of 8%. Okay, so we purchased this truck by paying 2,000 cash, and the rest is for with the uh, zero interest bearing note. Okay, so remember, if something like this happen, we need to calculate the present value, okay, rather than directly calculate it is 20,000. So we calculate the present value of the truck, yeah, which is 20,000 divided by 1 plus 0.1 at the power of 1. Yeah, because only 1 year. Why we choose the 10%? Because this is what the Haider Corporation normally would pay. So of course the company would use this interest rate rather than the dealership incremental borrowing rate. Yeah, so that's why we use the 10%. So the present value is 18,182, already rounded to the nearest dollar. So we will record debit truck number 2, 18,182. The rest will be the debit discount on notes payable 1,818. Yeah, and then credit cash 2,000 that we pay, and then credit notes payable 18,000 that we issue, the zero interest bearing note. So this discount later on that it will be amortized, yeah, like the way that you do usually using effective interest rate. So the truck amount later on, yeah, it will be 20,000 after 1 year. Okay, so number 3, truck number 3 has a list price of 16,000. It is acquired in exchange for a computer system that Haider carries in inventory. The computer system costs 12,000 and is normally sold by Haider for 15,200. Haider uses a perpetual inventory system. So this is an exchange of non-monetary asset. So we want to get the truck number 3 by exchange with our computer system. Yeah. So which one that we should record 16,000 or 15,200? Of course, the 15,200. Yeah, because this is the fair value of uh, our asset that we want to exchange. So remember, we will use the fair value. Okay. So this is just like we sell the computer system to get the truck. Yeah, so that's why we will debit truck number 3, 15,200, credit sales 15,200. And then because using perpetual system, you will want to debit COGS and credit inventory of 12,000. Yeah. And then number 4, truck number 4 has a list price of 14,000. It is acquired in exchange for 1,000 ordinary shares in Haider Corporation. The shares have a par value per share of $10 and a market price of $13 per share. So this is just like what you have learned in accounting 2. When we want to acquire an asset, we can also exchange with shares. So we will of course record the market price instead of the par value. Yeah. So the truck number 4 will have the fair value of 13,000. Yeah, from $13 times 1,000 ordinary shares. And then the credit shares capital ordinary, this is on the par value. Yeah, so 1,000 times 10. And then credit one more is share premium ordinary. So this is the same with contributed capital in excess of par. Yeah, the 3,000 is from 13,000 minus 10,000.